Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Scott Kefer, senior portfolio manager at VictoryShares and Solutions, to discuss volatility weighting. Is it a better way to diversify? Scott, it's great to see you. Welcome back to Trade Talks.
Thanks. It's great to be back, Jill.
And Scott, some investors are concerned with the extreme concentration in market cap weighted products and how a few mega caps have been driving recent performance. What would you say to these investors?
Well, Jill, I mean, we would agree. We've definitely reached extreme levels of concentration. When you look at the top 5 positions in the S&P 500, Apple, Microsoft, Amazon, Facebook, and Google, combined, they're about 22% of the index weight. And you've got to go back almost 50 years to the early 70s when oil companies dominated the index to find that level of concentration. You know, even in the late 1990s, during the height of the tech boom, the top positions, the top 5, were about 15 to 17% of the index weight. And, you know, don't get me wrong, the concentrated nature of these cap weighted indexes have served investors very, very well over the last few years. The mega caps have really done an exceptional job outperforming. But concentration can work both ways. And we would argue that after the run we've seen and the multiple expansion that some of these names have benefited from, you know, as the economy begins to reopen later this year, an economy that's being supported by unprecedented levels of monetary and now fiscal stimulus, we believe we're going to enter a period of greater market breadth. And with greater participation from a broader set of stocks and sectors that go beyond just the mega cap and growth-oriented holdings. And in this environment, we believe a more diversified approach to portfolio construction really has a greater likelihood to outperform.
In your opinion, is there a better way to fill a core equities allocation?
Well, yes, as I said, you know, we believe in a more diversified approach to portfolio construction, that it's likely going to be better positioned going forward. In particular, you know, when you're thinking about a solution that's designed to fill your core equity allocation. So one approach that we really favor is called volatility weighting. And we use this approach across a number of our ETFs, including CFA, the VictoryShares US 500 volatility weighted ETF. You know, and in this approach, stocks are weighted based on the inverse of their trailing volatility. So if in your portfolio, for example, you own Twitter and you own Coca-Cola, because Twitter is more volatile, we make the position size a little smaller. And because Coca-Cola is less volatile, we'll make it a little bit bigger. And when you apply that methodology across all 500 holdings, the goal is to have each stock contribute an equal amount of price volatility to the total portfolio. And by equalizing each constituent's volatility contribution, you end up with a far more diversified portfolio than a cap-weighted approach. You know, typically in a 500 stock portfolio like CFA, the largest position will be about 40 basis points and the smallest about 10. So it's quite a bit different and quite a bit more diversified than something like the S&P 500, where Apple and Microsoft each are about 500 basis point positions.
How does volatility weighting differ from some of the other popular alternative weighting methods, such as equal weighting and a low volatility approach?
So that's a great question. And it's really important to point out that volatility weighting is not the same as a low volatility approach. You know, as I said earlier, volatility weighting seeks to equalize the volatility contribution of each stock. A low volatility approach, on the other hand, is really trying to only hold the least volatile stocks. So in a low vol portfolio, a stock like Twitter might be avoided altogether. And the drawback of a lot of low vol approaches is that they're often sector agnostic. So they're simply trying to find the least volatile stocks, no matter the industry. So you often end up being very concentrated in the least volatile sectors, where your portfolio could end up with significant overweights in areas like utilities or staples or REITs. So therefore, a low vol approach, again, may not be ideal as a standalone core equity allocation. It might not give you the diversification you're looking for in that core building block. And then an equal weight, like volatility weighting, does seek to provide a more diversified portfolio construction. You know, in an equal weight 500 stock portfolio, every position is 20 basis points. And again, this compares to our volatility weighting approach, where it's 10 to 40 basis point range, as I described a little bit earlier. But when you equally weight 500 stocks, and staying with that Twitter and Coca-Cola example, and you make the more volatile stocks like Twitter the same size as the less volatile stocks like Coke, the equal weighted portfolio often ends up having higher overall portfolio volatility, than either a cap weighted or a volatility weighted approach. And once again, likely not the desired outcome you're looking for in your core allocation. So in the end, when you're looking to all of these approaches, volatility weighting really seems to strike the best balance of diversification and a level of total portfolio volatility that's comparable and sometimes less than a cap weighted approach.
Well, Scott, what impact does volatility weighting have on Fang exposure and tech more broadly?
Sure. So I usually define Fang as Facebook, Amazon, Apple, Netflix, Google, and Microsoft. So all 6 of those stocks. And those 6 stocks were a little over 22% in the S&P 500 at year end. In CFA, volatility weighting, these holdings are just over 1%. As for tech, in the S&P 500, technology was over 25% of the index. In CFA, tech is about 17%. So with CFA and a volatility weighted approach, you still own the FANGs, you still own tech, just in smaller weights. Again, a reflection of the increased diversification that can come from a volatility weighting approach.
Scott, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.